Hello and welcome to this Tuesday's morning market briefing. We've got lots to talk about, but firstly, private equity owners pile on debt to pay themselves dividends, as well as that 6 Syrians have been killed in an attack on a US base following weekend strikes. There's lots to talk about on the charts also, with lots happening on the economic calendar, but we'll come to that near the end, so make sure you stay around so you can see that. Before we get straight into it, make sure to subscribe. But the first article to talk about is on the private equity front and talking about the private equity sector. Now, private equity firms in the US are now attempting to exploit lower borrowing costs, and this comes as the firms load debt up onto their portfolio companies and use the cash to pay dividends to themselves and their investors. Now, we do visit private equity as a topic, sometimes, but it's definitely not one of those topics that we're always talking about. But nonetheless, it is so important to understand, as it largely makes up a great deal of companies and kind of asset classes which you might think of investing in or investigating in terms of investing into that sector. And ultimately, private equity has had a turbulent history over the past 5 years, really, during the COVID lockdown period to begin with, and then also seeing those higher interest rates as we did come out of the COVID period and experience that inflationary pressure as a result. And since then, private equity firms have really struggled, and we've spoken before about the different strategies which private equity firms and owners have had to kind of implement in order to deal with those turbulent situations. Ultimately, though, private equity firms such as KKR and others have ultimately been able to kind of get around the issues. And as we do begin to emerge into this period where we are exiting the higher interest rates which we've been kind of dealing with for the last year or two, ultimately this is now enabling private equity firms to come right back into their element and start exploiting those lower borrowing costs and start kind of incorporating some of those strategies which maybe they were using and testing out during the COVID lockdown period, where obviously we did see all-time low interest rates, even around the neutral level for some nations and especially the US. And therefore, as we do kind of head towards those inflationary targets of 2%, and the Fed does take a more dovish tone in regards to its monetary policy, we are increasingly coming close to the time where private equity can start to incorporate some of those older strategies. And this is important to understand, as it will reshape then, the kind of private equity sector and also the companies and industries which private equity firms might be interested in. And that's why it's so important to keep your eyes on and understand. Ultimately, though, when we are talking about private equity recently, it is on the topic of the Fed. And most recently, we have heard more dovish rhetoric. And that is despite, of course, receiving that more hawkish outlook last week on Friday from the NFP figure, which kind of worried certain investors, or not certain investors, certain investors into US equities, ultimately because, a higher NFP figure like that in the 300,000s range did kind of, represent a large deal of inflationary pressure still in the economy. And this does create worries, as ultimately it means that maybe the Fed won't be able to achieve that 2% inflation target, and therefore it won't be able to cut interest rates as much as investors expected or as early as expected, and therefore mess with the predictions and the Fed's monetary policy. Ultimately, though, it does seem that the markets are pricing in a more dovish kind of market outlook from the Fed, and a more dovish monetary policy kind of action from the Fed, with interest rate cuts even possibly coming in March. That is still, somewhat expected by certain investors, however, not as much as before, obviously. So this is a very important topic to understand, with firms selling $8.1 billion worth of junk-rated loans to fund payments to shareholders in January. This figure is 6 times more than the December figure and is the highest monthly figure in more than 2 years. It was weak deal volumes and weak demand for IPOs, which meant offloading investments was hard for firms, leading to firms engaging in dividend recapitalizations in order to return capital to investors. And that's been a key issue, is that weak demand for IPOs. And this is all obviously being driven by the Fed's monetary policy, with that more hawkish monetary policy that we have seen recently weighing on many companies' abilities to take place in initial public offerings and other forms of kind of debt restructuring, and also offering up their stocks and shares. And as a result, this has been affecting private equity, which uses those kind of corporate restructuring methods to essentially get out of their investments or cash in from a bit of their investment. So that's why we're now starting to see these different methods being employed by private equity, as we've previously spoken about with other strategies, in order to enable private equity firms and owners to sort of cash in on their investments nonetheless. Now, the opportunity to do such a thing was provided by the sharp drop in borrowing costs in recent months, which as a result has helped private equity firms to do such a thing. Many private equity firms are facing pressure from investors to return some cash. This strategy of dividend recaps were popular during COVID, but following rate rises, the strategy fell out of favor for certain firms. Warburg Pincus and Blackstone have borrowed about $800 million since December against InfraFi Network to pay themselves a large dividend. Since the Fed pivoted on its interest rate stance at the end of last year, private equity firms have utilized this opportunity to refinance and lower their interest rate burdens. So-called repricing volumes for US junk loans soared to $91.2 billion in January, so significant capital volumes during the period of January, and this is largely being driven by the Fed's monetary policy outlook and strategy. And that's why when we're talking about the Fed so much, it's important to also understand how this is not only just affecting the way we're seeing markets, but how it's also affecting certain other financial industries, with private equity being a key one in regards to US equities. So definitely keep your eyes on this topic in regards to private equity. Very important indeed to understand. Next article to talk about though is in regards to the Middle East don't know why this is kind of bugged out. It's frozen for a second, but this article I can kind of go on without it showing, but ultimately this article is in regards to 6 Syrians being killed in an attack on a US base following weekend strikes. Now, the first major attack since the US struck Iranian-backed militias took place yesterday, with a drone attack on a military base housing US troops, killing 6 allied Syrian fighters. Now, we've been talking a lot about the Middle East, and for good reason. We are seeing heightened tensions to levels not seen, of course, since the Iraq War, or even ISIS's presence within Syria and Iraq. And following this kind of heightened tensions, we've seen certain regional actors become far more involved than before, and those actors being Iran, of course, with their many proxy groups within the region, kind of wreaking havoc on certain nations or certain militaries. And 2 key groups to note in regards to that, of course, is Hezbollah first in the north, not in the north, but in the south of Lebanon, which has been clashing with the IDF on the Lebanon-Israel border, but also the Houthis, of course, in Yemen, which have been attacking maritime commercial vessels, even causing a British-owned vessel to kind of abandon ship, where we did see that British vessel catch on fire following a missile strike, and then the crew on board then did have to abandon ship, with other nations' vessels kind of putting out the fire. And this kind of caused many worries. We were kind of not understanding how this might affect different actors, and of course this has shut down the Red Sea and Gulf of Aden really as a key trade route for many nations, with a kind of Western allied group basically now being set up to deal with the issue of the Houthis attacking merchant vessels. And as a result, we've seen both US and UK strikes on Houthi targets within Yemen. This has obviously caused a great escalation to the conflict already, and all of this is kind of began following, of course, the October the 7th attack on Israel by Hamas, and the following, Israeli response, which was an air operation as well as a ground and naval operation into the Gaza Strip, which is still taking place. And so this has kind of caused great heightened tensions, and now we're seeing that kind of play out also in Iraq and Syria, where of course we know there are many Shia militant groups which are funded by Iran, and as a result those groups have been attacking US bases and US troops that are stationed in these key areas, which are there to basically maintain stability in a region of great instability, really. And one of these key allied groups which have now been hurt is the SDF, the Kurdish group based in Syria, which has been supporting the US. The US has been supporting this Kurdish group, and ultimately this Kurdish group has been fighting many other militant groups in the Syrian civil war and Iraq war as well. So this is the current situation, and obviously the worry is that the more of these attacks take place against US bases and that kind of thing, the more likely the US is to get involved in this conflict in a kind of way where US troops are fully deployed on the ground to fight these groups or even fight Iran. And that would of course have great effects on the market, with oil in particular being greatly affected should the US kind of join in a regional war in this region. So that's why it's so important to understand and keep your eyes on. Now, the IRI group responsible for the first killing of 3 US troops claimed responsibility for the attack, and this follows 160 attacks against the US already launched by the umbrella group. The attack hit Al Omar oil field within a US military compound. The US allied Syrian group of the SDF said the drone used in yesterday's strikes was launched from eastern Syria and blamed Iranian-backed militias. The area where the drone was launched from is under control of the Assad regime, which is of course friends and allies with the Iranian regime at the moment. So no US casualties were reported from the attack, however, but the attack will still heighten certain fears around the US getting further involved into a regional conflict. The group that launched the attack, the IRI, includes numerous Iranian-backed militia groups which have launched a number of attacks also against Israel since October the 7th. The Biden administration has warned he will continue attacks on Iranian-aligned militias, whilst also repeating that they want to avoid a regional war. So this is very important to understand, and is greatly affecting world tensions, and is also influencing certain assets in the market, such as gold and oil, which we'll come to in the charts in just a second. And that's all to talk about in regards to the charts. We've covered lots there, but next to talk about, of course, is the charts, where we have lots to talk about. I'm sorry if I just said charts too many times, but ultimately we're now talking about the charts, with the US 30 being first to note in regards to the US indices as a whole. Now, on the US 30, we have seen a large response following, of course, the NFP figure that we did receive on Friday. Now, that NFP figure was significant indeed, with over 300,000 jobs being added to payroll in the US, and as a result this kind of represented a new inflationary pressure for the US, which hinted towards maybe the Fed taking a more hawkish monetary policy kind of strategy to deal with this possible inflationary pressure. And this would of course mean US interest rates staying higher for longer. And that's why we are seeing this sell-off now on the US 30, as investors do begin to price in US interest rates staying higher for longer, and as a result keeping borrowing costs higher for these businesses. After all, really we've only seen a push to the upside for US indices since the Fed did change its monetary policy view from a kind of more hawkish view of keeping rates higher for longer to a view which more so represented a very kind of dovish outlook, where they were more so talking about when interest rates were to be cut rather than when interest rates were to be raised. And as a result, we did see a kind of US equities rally as we did end off the year, breaking above those all-time highs as marked out by this line. But then going into the new year, this year, of course, we did see price kind of stall out, range, price, allowing, investors to kind of accumulate orders and sell off and maybe, kind of put their money into different assets. And, as we've kind of gone into February now and ended off January, we have seen this kind of rally return. Ultimately, though, we have been receiving more and more hawkish information in regards to the Fed and, US interest rates. And, that NFP figure on Friday is the reason why we have now seen this sell-off. So the US 30 is in a very, very interesting position. And I think the key thing right now is to look out for these key Fibonacci levels, key liquidity zones, and maybe mark out where price could retrace to on a bearish kind of move, but where then price could move away to the bullish side. So definitely keep your eyes on the US 30. Next to talk about, though, is the dollar, which is in a very important position nonetheless. Also in regards to, the NFP figure that we did receive on Friday, as of course, that NFP figure did represent more of a hawkish monetary policy outlook maybe that the Fed will now pursue. And as a result, we've seen the dollar kind of move to the upside as investors do start to price in, the dollar, maintaining a higher interest rate for longer, and therefore enabling investors to kind of put their money in the dollar and earn a greater level of interest than elsewhere. And that's why we are now seeing the dollar push to the upside. That said, this is one figure only, and ultimately it doesn't seem like the Fed's monetary policy will just change off one figure alone. It's more important to look at the inflation figures and, other sorts of figures as well. And as a result, we should also be looking at levels where, whilst price has moved to the upside, where price now may react and then move to the downside from that level. For example, if we just mark out this level over here, where we've previously seen a sell-off, that is where price is currently sitting. So whilst it isn't a key level that price is at the moment, there's definitely going to be some bearish momentum around there as well. So, definitely keep your eyes on the dollar. Super interesting level to be noted at the moment. So yeah, keep your eyes on the dollar. Next talk about though is Euro USD. So a key dollar pair, and as a result of the dollar gaining strength, we have seen Euro USD sell off to the downside, and now basically Euro USD has kind of lost all of those gains seen since the 11th of December, when we were hearing some interesting news from the ECB in regards to rates maybe staying higher. But since then, of course, the more hawkish outlooks presented by certain US data, how that's influenced perceptions in regards to the Fed and federal monetary policy, has led Euro USD to kind of lose those gains and kind of Euro USD selling off. So now we're kind of at this double bottom level. It will be interesting, therefore, to see whether price does react to this level and move to the upside as a result. So definitely keep your eyes on Euro USD. Next to talk about, though, is pound yen, which is now kind of retracing on those bullish moves that we did see ending off last week. It'll be interesting to see, though, whether we do maintain the bullish momentum found following hitting this liquidity zone last week, as this was a key level as price was at its all-time highs and then slowly retraced to the downside, reacted to that level and is now on the upswing. So maybe price does now continue to the upside from the 61.80 that it's sitting at on the short term. Keep your eyes on pound yen. Next to talk about, though, is Bitcoin. Not much to say on Bitcoin. Price is stalling out and around some key liquidity zones. Next to talk about, though, is gold. Gold is in a very interesting spot as a result of the very high world tensions at the moment, which is of course pushing gold to the upside. But then also the more hawkish messages that we're getting from the Fed recently, within the last month and that kind of thing. And as a result, we are now seeing the dollar move to the downside as a result of the dollar gaining strength, as these two kind of are inversely correlated as a result of gold being that kind of safe haven asset for those that want to avoid US inflationary pressure. As a result, we have seen seen gold sell off, but ultimately we still need to keep our eyes on world tensions, as this is greatly influencing gold. So if we do see continued attacks by Iranian militia groups, and we do see continued US involvement in the Middle East, we could definitely see gold make a move to the upside. So keep your eyes on gold. Next to talk about though is oil, and lastly to talk about is oil, where, you know, whilst yesterday we were kind of talking about how price had now broken below that 78.60 level and was now on the more bearish side of the market, ultimately price has found some bullish momentum, it does seem, and is kind of pushing its way to the upside nonetheless. That said, it is reacting to this bearish level of liquidity, so maybe we continue a sell-off from that zone. Definitely keep your eyes on oil though. That's also being influenced by the regional tensions in the Middle East. That's all to talk about on the chart. So lastly to talk about, of course, is the economic calendar, where we are getting quite a bit of data today to get through. Now, firstly, we are getting British retail sales data as well as their construction figure, so some important British data right there. As well as that, we're having the Aussie interest rate decision and press conference. So any Aussie pairs that will be greatly affected by that decision, as well as the rhetoric from the RBA. So listen out for that. Some important Eurozone data to note, of course, is the Italian and Spanish business and consumer confidence figures. So listen out for them for sure, as well as the Canadian Central Bank official speeches. So a few of those to listen out for today, as well as numerous Fed officials' speeches. And finally, we will be getting the New Zealand's unemployment rate figure. That's all to talk about though on the economic calendar. We've covered lots on the articles, lots on the charts, and lots on the economic calendar. Have a great trading day this Tuesday, but that's all from us at Wildwood Capital. Have a great one. See you later. Bye.